Next up is the special address by Navneet Munot, MD and CEO of HDFC Asset Management. Navneet, of course, needs no introduction, but for the record, Navneet has over 28 years of experience in asset management and financial markets. And prior to HDFC, Navneet was the CIO of SBI Mutual Fund. Navneet is a chartered accountant by education and a charter member of the CFA Institute. Navneet is a prolific writer and his articles are very well sought after by all the industry professionals. With no more ado, over to Navneet Munot.
Good afternoon. Thank you so much for having me as part of 12th Knowledge Summit. It's always a great pleasure to be amidst IFA Galaxy members. We have gone through an extraordinarily challenging time over the last 2 years, but our industry not only showed a huge resilience, but also worked with greater resolve to serve our investors. You all were at the front line and deserve a salute. I would say a standing ovation for your human service. No crisis should be allowed to go waste. As Albert Einstein said, in the midst of every crisis lies a great opportunity. And very humbly, I can say this. Our industry used this crisis to find new ways and innovate to serve our customers better. We leveraged the power of technology. We reinforced our commitment on investor education, and industry has witnessed rapid growth. And notwithstanding the recent volatility in markets, I have no doubt in my mind that mutual funds are ready for the next big leap. I'm saying this when there are these clouds of uncertainty around us. The recent headlines would surely make one quite nervous, seeing the geopolitical risk, seeing the uncertainty around global monetary policy and various other things, which has led to not only a steep correction in markets, but also heightened volatility in markets. While I feel very positive about our economy, I surely have concerns around global environment. And there are 4 P's, words starting with P, that I've been highlighting as risk since last year. The first was, of course, pandemic, but I said that's a known risk, and the humankind seem to be learning to live with it. The second P is prices or inflation. Just to make this as an acronym, I'm using the word prices, but otherwise I mean inflation. It's been a decade of underinvestment in new capacities. It's very visible in several commodities. Labor markets have tightened. Easy liquidity is also playing a role, along with several supply side challenges. I mean, we have seen the chip shortage, we have seen shipping shortage, we have seen all kinds of supply side challenges at a time when global demand is increasing fast. And rising prices will complicate the policy making for central banks, who on one side need to remain quite accommodative to ignite the animal spread, to support the growth momentum, to ensure that the aftermath of pandemic doesn't lead to a slowdown in the economy on one side. On the other side, they cannot allow inflation genie to move out of the battle. So that's the second P, a potential policy error by global central banks in either being too early to take the punch bowl away or too late to allow a wage price spiral going out of hand. The last P, which I had highlighted quite a bit last year, was politics. That's an unknown. The other risks were either known or known unknown, but this one was like unknown, and markets were not paying enough attention. Just like the risk of pandemic was never looked at by anyone before 2020. My view has been that a new Cold War has just begun, and the world needs to be concerned about ambitions of leaders like Xi Jinping and Putin. In my Person of the Year article, I wrote at the end of last year that, and I read, the fall of USSR 3 decades back ended a long, bitter Cold War. Another one may have just begun. Looking at a Talibanized Afghanistan, looking at the prying eyes of Putin on Ukraine, and wolf warriors tactic on Taiwan. Of China on Taiwan make one nervous. I hope better sense prevails. Of course, there could be many other risks, but these are the ones I would say are critical to watch out for. Now, how do you hedge these risks in your portfolio or in your investments? It's difficult to hedge, but following the fundamental tenets of investing, asset allocation in its truest form, diversification, discipline, rebalancing are the ways to deal with these risks rather than reacting to the news flow. And news flow will remain like this for quite some time. As far as India is concerned, I think the world is entering a new period of reflation. And I'm saying this notwithstanding the fact, the geopolitical risk that we have seen over the last couple of days. So this is despite the geopolitical challenges, I would say that world is entering a new period of reflation, which is driven by easy liquidity by central banks, by fiscal stimulus, by a lot of innovation, and of course the growth enhancing policies by several governments in the world. The geopolitical realignment augurs well for India as world will look favorably at India, both from a strategic perspective, as well as investment destination, and of course, as a trade partner. RBI's strong resolve on supporting growth and government's commitment on reforms are structurally positive. If I add one more thing, after a sluggish growth for almost 6-7 years, housing sector is entering a new cycle, and that has a multiplier effect. So revival of investment cycle is around the corner with government focus on infra spending, with PLI related policies, improved balance sheets of corporate and banking sector. In fact, the higher commodity prices also lead to big capex by those companies. So on and so forth. I mean, I believe that a new investment cycle is likely to begin. And with lower interest rates, lower corporate tax rate, which the government cut a few years back, cost rationalization and innovation that companies have done, particularly during this COVID period, and growth coming back, we expect corporate profit to GDP ratio inching up over the next several years. And we have already started seeing signs of that. So while global risks that are highlighted before would impact India as well, and particularly wherever valuations had run ahead of fundamentals, one needs to be careful about those pieces. Overall, I feel positive about India and Indian economy. We are surely in a VUCA world, volatile, uncertain, complex, and ambiguous, and they would cause higher volatility in markets. Also, the policy response to the crisis was absolutely extraordinary post-March 2020, and that liquidity support will be taken out gradually. And all this will cause more gyrations in market. But I would say one thing, that investors should use volatility as an opportunity rather than getting swayed by it. Coming to our industry, it has a lot to celebrate. 37 lakh odd crores of AUM, 11 crores folios now. In fact, more than that, 3 crore unique investors milestone has been achieved, 11,000 crores plus in SIP. But we have a long way to go. In times like these, when headline news flow and the market trends are worrisome for our industry, I would say there are 4 things that we should keep firmly in our mind and not get swayed by the news flow. One, continuing growth in the Indian economy, I think will remain one of the fastest growing economy in the world, and we have a long way to go, starting from a base of $2,000 per capita GDP. The second, household savings will continue to increase. In fact, they have come down over the last 5-7 years, and our sense is that over the next several years, as the job creation and income levels rise, the household savings will go up as well. Third, the larger part of these savings will come to the financial market, so financialization of savings. And fourth, digitalization will make all of these trends, the momentum will enhance because of the higher digitalization in the country. Over the last 2 years or so, we have seen demat accounts have almost doubled from 4 crores to 8 crores. A lot of IPOs, interest in cryptos, and so on and so forth. There are 2 ways to look at it. One way to see that as competition from a mutual fund product perspective. The other is to see it as increasing interest in capital markets. Also the fintechs, I mean, they did around 4 lakh SIPs, if I remember correctly, in FY March 20, they did around 35 to 40 lakhs in FY21, and they've already done over 70 lakhs in the current year. Now, whether it's a rising interest in direct investing or the rising, the SIP creations through fintechs, they should be looked at as a reflection of savings getting financialized. This huge SIP creation by fintechs is clearly exhibiting that mutual funds are a pull product now and no longer a push product. We are seeing increasing penetration in smaller towns. We are seeing increasing penetration among the younger lot, among the women, and so on and so forth. And it's our collective responsibility now to take mutual funds to every nook and corner of the country. As I said, I think the thing to learn from all of these is like to have the focus on digitalization. How do we get more efficiency in our business, and how do we continue to remain focused on investor education as well as doing the right handholding of our investors? And I'm sure mutual funds are a pull product now, and there is a lot of interest across the country. I just want to touch upon one more topic, which is like a lot of discussion we hear around passive versus active. Passive funds have been growing. If you look at as a percentage of overall equity funds, I mean, they have grown to now, I think 16, 17 odd percent. Even in the fixed income, there has been growth of passive funds. New products are getting launched. So investors have wide variety to choose from. And I will say two things. One, that yes, passive has place in some portfolios, and we should offer the whole bouquet to investors. But I would hasten to add that I remain quite positive on alpha generation capability of Indian fund managers. Think of it. I mean, just a year back, people almost wrote off active managers, but we have seen a renaissance now. Last year, we saw huge alpha generation by several of the fund houses. And I think this is just beginning of a long period, because the rally was so polarized for a couple of years, 2018, 19, 20, and as rally gets more broad-based, for the reasons that I talked about earlier, I'm sure we would see a continuing alpha generation. There is a long period of alpha generation track record of active managers. I mean, we have seen a fund like HDFC FlexiCap multiplying money 100 times over the last 25 years or so. So, I mean, trying to time the market may take away the actual alpha investors make over a long period of time. And I think passive, as I said, has some space in the portfolios, but at the same time, there's a lot of potential in the active funds as well. So it won't be either passive or active. I would say there is potential for both to grow in India. I will end by reiterating my conviction that Indian economy has a long way to go. I remain quite positive. I think given the powerful forces of demographics, democracy, demand, and now digitalization, from $2,000 per capita, we have a very, very long way to go. Within that, household savings will continue to rise. Financialization of savings mean greater demand for products like mutual funds. And of course, the digitalization is giving us an opportunity to think about our business very differently than the way we would have thought some time back. As long as we keep customer at the center and stay true to our purpose, I'm sure our industry is definitely ready for the next big leap. Once again, my sincere thanks to IFA Galaxy for having me, and wish you all the very best. Thank you so much.
Thank you, sir. Thank you so much. This is very informative and need of the hour, I would say. If I may ask you a couple of questions around this will help us to take this message forward even better. One is, as an industry, you talked about how the industry has grown over the last many, particularly in the last couple of years. But from a MF as an industry, we haven't managed to sell solution-based funds in a big way. So how do you see solution-based funds playing an active role in the portfolios of our clients? What else we need to do so that we can make it more popular and we can take it more closer to the clients?
You're absolutely right. I mean, a lot of time gets spent on the view on the market, view on macro, whether to invest in large, mid, or small cap, whether within the fixed income, whether to invest in duration or credit, so on and so forth. But I think a large number of investors, the real challenge is how do they meet that goal? The goal could be like a child's education. The goal could be saving for their retirement. And I think our industry has the right products. And I'm sure there is a lot of potential for us to ensure that we get long-term savings to meet investors' actual goals rather than trying to do a lot of other things that we do. And I'm pretty sure that over a long period of time, relative to all the other competing products which are there for on which the investor look at for getting the solution to the real needs or to their goals, there's a lot of potential for the industry to go on the solution-based fund. I'll add one more thing. Given the level of public debt as percentage of GDP, whether it's India or whether it's any other part of the world, taxation on individuals will remain high, be it like in any form. I mean, the governments world over will try to maximize their tax revenues to ensure that the debt to GDP comes down. We have cut the corporate tax. It will be very difficult for us to do any to revisit that. GST has to get rationalized. So the tax burden will remain on individuals. And within that, it's very important that we keep in mind that aspect, how the tax impact your portfolio allocation or your portfolio churn or rebalancing over a period of time. And from that perspective also, I think the role of solutions-based fund where you invest and get the asset allocation right and you don't have to rebalance from one fund to another also plays a very, very big role.
Thank you, sir. Thank you so much.
Sir, you have given a really a good account about the industry. You have also given about the macro outlook. There is only one question always lingering in the minds of MFDs and also in the minds of investors. It is about the size of each scheme. Do you think the scheme becomes larger and larger? Is it difficult for a fund manager to create alpha and to keep on repeating the performance? Or do you think there is any other methodology by which MFDs can decide the fund selection?
So in 2013, sometime in 2013-14, I mean, before this bull market began, the total size of equity funds in India was 2 lakh crores. And at that point in time, this question used to get asked that funds are very big, whether they would generate alpha. And from there, we have grown 6 or 7x, more than that actually, almost 8x. The one fund house like ours and a few others are managing that much of money that industry was managing. Having said that, if you look at the total market cap, I mean, we almost touched the high of $4 trillion. Of course, it has come down in last few days or few weeks. We as an industry, as a percentage of the overall market cap, are still very small, and we have a very, very long way to go. I mean, as I mentioned about the alpha generation capability of Indian managers, I mean, look at this year alone, last 12 to 15 months, the amount of alpha that has got generated in our funds, and the same is true of several other fund houses and several other funds. I think just goes on to say that I think we have a very long way to go, and our size in absolute terms, because if you have seen one fund at 1,000 crore has become 5,000 or 5,000 has become 15,000 crores, we look at it in absolute terms, but I think you have to look at it as the size of these funds compared to the size of opportunity in market. We also need to keep one thing in mind. There are large parts of the economy which are yet to get listed. There are so many of these businesses, as the point I mentioned earlier, as we go from $2,000 to let's say 3,000 or 4,000, there would be several new industries, and also in line with the changes globally, there'll be several industries, several sectors, several companies which are yet to come for listing. We know, I mean, one of the largest company or the largest company probably in terms of the balance sheet size is likely to get listed in next few weeks. So the investable pool is also increasing at a very, very fast pace in India. We are not, let's say, have reached a stage where I think almost everybody who could get listed has already got listed. There is a limited pool, and the money with the institutional managers like us has become so large. I think we are nowhere close to that stage.
Thank you, sir.
Sir, continuing on this discussion, one of the things as MFDs we have been consistently facing is about how do we, as a MFD distributor, how do we take and sell these debt funds in a scenario where the interest rates are very low and the customers are searching for yields? So if you look at the overall credit market or overall debt market, we find that the high quality credits are has a very low yields, and probably we find higher yields in sub AA or AA minus kind of thing. In this scenario, what is your advice to MFDs? How do we handle this? How do we overcome this?
In fact, the recent volatility in the equity market has again highlighted the importance of asset allocation, and every individual, depending on their their savings and investment levels, time horizon, liquidity preference, I mean that the longer term goals, and of course the risk appetite, need to allocate across all asset classes. And in times like these, I mean, you understand the importance of asset allocation a lot more than let's say good time in any particular asset class. It's very important to have that fixed income allocation. You are absolutely right. I mean, given the situation over the last 2 years or so, interest rates have come down very significantly. Policy rates are near historic lows. They are likely to go up from where we are today. The one interesting aspect in this cycle has been that the yield curve is very steep. While the policy rate, the effective policy rate reverse repo was at 3.35, or if you look at your returns in overnight fund or liquid fund, they have been closer to that. But the 10-year bond yield was hovering around 6% and or substantially higher than that. It didn't come off as much as what it happened in the previous cycles like January 2009 or in 2003-04. So curve was very steep. So a lot of policy rate hikes over the next several quarters or years kind of like priced in at the long end. I'm not saying that long end yields may not go up. They may still go up as rates go up, as inflation inch up, as growth comes back, as credit growth comes back. But I think to some extent it's already priced in, and you also get the benefit of the carry and the roll down effect if you are investing in medium term or so. You talked about the credit fund, and I mean all of us must give the credit to the industry that over the last 3 or 4 years, the kind of volatility we have seen in interest rates, the kind of ups and downs we have seen in the liquidity in the system, and more importantly, the kind of challenges that credit markets has gone through, I think by and large, industry has done a very, very good job. Of course, there are always learnings, but I think overall, by and large, industry has done a good job. I think some bit of money has started flowing back into the credit funds. I think as economy starts improving, I talked about the new investment cycle, etc. There would be more opportunities in that space. The current yield is pretty decent relative to some of the other funds, and that can also be looked at, particularly for the investors who have some bit of appetite on the credit risk. Otherwise, I think given where we are in the rate cycle, I think the short end of the curve is good. I mean, let's say a banking and PSU debt fund, a corporate bond fund. I think those kind of funds are good for the investors. And it's important, again, I mean, repeating the same point that I think times like these highlight the importance of asset allocation even more.
Thank you, sir. I completely respect your thing. Very, very important. Sir, one last question. I know we are running short of time, but it's very important for MFDs to know how this inflation in the Western world will impact the economies, or particularly our economy, and what kind of impact we can see. Maybe a quick take on that.
See, I think we have seen inflation. I mean, we have been part of a country where we have several bouts of higher inflation. I think in 2012-13, we saw close to double digit driven by the food inflation and other commodity prices, crude oil, etc. I think we have seen those bouts of inflation. We were very lucky last several years where inflation has been well behaved. commodity prices were low. But I think there are various factors at play. Number one, I think the amount of money which has got unleashed, right from the crisis in 2008 by the central banks, and more so after the COVID crisis and starting from March 2020, the amount of money which has been printed by central banks is absolutely extraordinary. They have been just short of throwing cash from helicopters. And coupled with the amount of money which has been printed or which has been kind of like spent by the governments world over. So combination of fiscal stimulus and the monetary stimulus has been absolutely extraordinary. And I know, if I remember, it was Milton Friedman that inflation everywhere and every time is a monetary phenomena. It hasn't played like that since 2008. Any amount of money printing didn't lead to inflation because money multiplier wasn't working. The banks were not lending, or the borrowing wasn't there, or people were not leveraging as much. Particularly the business side wasn't leveraging as much. We were not creating the newer capacity. So incremental money didn't lead to inflation. But I think at this level of amount of money which is there in the system, I think is going to lead, because there are few of the other factors at play. One is also the deglobalization. I think after this crisis, everybody wants to diversify the supply chain. We are moving from a hyper optimization to a more, I would say, China 1+, or various countries or businesses are putting in different manner. They want to diversify the supply chain rather than hyper optimize. This also leads to a little bit of inflation, right? Because you are not importing from the cheapest source, but you are importing also from more reliable source. So that adds to inflation. And a lot of countries, I think it's part of the deglobalization. A lot of countries have put tariff barriers, they have increased tariffs, or have done other things to have less dependence on, let's say, imports from China, etc. So this is also playing a role. Over the last 10 years, because commodity prices remained low and maybe the ESG effect and a couple of other things, the incremental investments in new capacity creation has been very low. And we are seeing the result. When demand has gone up, suddenly commodity prices have spiraled out of control. Oil crossed $100. So people were talking about the peak oil, but before the demand saturating, I think we have seen the supply saturating. Of course, higher prices will lead to investment. Things will come back to equilibrium at some point in time, or maybe more capacities will get created. But in the interim, I think we are in a period where we may have to live with higher prices. Now, this is not a bad scenario, honestly, for West. West has been wanting to get inflation back for a very, very long time. They've gone through a high deflationary period right since 2008 crisis, and some bit of inflation is not bad. Also, we have to keep one thing in mind, that the public debt levels are very high. And how do you bring down the debt to GDP ratio? One is that you work on higher growth. The second is you also try to increase the denominator. Denominator is the nominal GDP, which is both real growth plus inflation. So higher inflation is not bad, because this will make the government debt or the overall debt levels look lower going forward. So inflation per se is not bad. I mentioned about the coming reflation era. We are moving from a deflation to a reflation. How does that impact India? I think if, let's say, because of that, if other asset classes or if other opportunities for investors turn more attractive, then definitely to that extent, foreign flows get impacted. If global central banks raise rates, I think that impact our flows. All said and done, while we have seen over the last several months how the domestic investors have been buying at a time when the foreign investors have been selling in the equity market. Having said that, still, the dependence on foreign flows as an economy is not small. We run a current account deficit, and we need foreign flows, and any volatility in global economy or any changes in global policy or any changes in global interest rate level or global liquidity impacts India as well. The one heartening feature is that now that we are sitting on over $600 billion of foreign exchange reserves, given that mutual funds have over 11,000 crores of SIP flows, I think the impact that we used to have in earlier episodes this time would be relatively less. But I think, if global inflation is going up and if global rates are going up, if global liquidity gets tightened, it will impact everyone.
Thank you, sir. Thank you so much for taking time today and joining us and sharing your thoughts on this important situation as we come out of the pandemic and probably as we go through some geopolitical situations. Thank you, sir. Thank you so much.
Entirely my pleasure. Always a pleasure to be part of with all of you in IFA Galaxy. Wish you all the very best. Thank you.
Thank you, sir. Thank you very much.
Thank you.